Hi, good morning, guys. Am I audible? Okay, so we'll wait for 5 minutes and start sharp at 10:30. Okay, so today we'll be covering corporate actions. So in 3 hours, I'm not sure if we'll be able to cover asset management as well. If it is not, we'll push that to tomorrow. Okay. Good morning, guys. How are you?
Morning, ma'am. All good.
So, what was covered in last class?
Ma'am, anti-money laundering KYC.
Okay. Any questions on that before we move on to today's topic? Yes, no, maybe. No? Okay. So today's topic is going to be corporate actions. So can anyone tell me what is corporate actions?
Some actions taken by any firm or any company in respect of their shares or their action means in respect of their shares or in the respect of their administration.
Okay.
Such as buyback, right issue.
Okay, these are examples of corporate actions, yes. And
Yeah.
Sunil says mergers and acquisitions, yes, it's a type of corporate action. So if you have to define what is a corporate action, it is an event undertaken by an issuer that may directly or indirectly affect the position holder. Is the screen visible to you guys? Yeah. So corporate action is an event that is undertaken by an issuer that may directly or indirectly affect the position holder. So who are issuers? Issuers are those institutions like companies, governments, financial institutions, etc., who want to raise capital. So primarily what they have done is they have issued shares or bonds in the market. So you have pre-existing shares and bonds in the market on which corporate actions can take place. So whoever issues bonds or shares in the primary market is called as an issuer. Who are position holders? Whoever holds the shares or bonds, they are called as position holders. So what does directly and indirectly mean? Direct effect would mean, for example, if you all were shareholders of maybe let's say my company, and I make an announcement that I'm going to do something called as a stock split, which we'll talk about a little later in class. Now, when I do a stock split, what happens essentially is the number of my outstanding shares in the market would increase, but the value or the price of my share would decrease. So in a sense, you are shareholders. Does it have a financial impact on your shares or a, let's say, monetary difference in your shares that you're holding? Anupam says no. Does everyone agree?
Ma'am, Olga ma'am.
Yes.
Ma'am, when the class started?
Just now, 1 minute ago.
Okay.
Okay, does everyone agree with Anupam? With the example that I just gave, your shareholders, I announced a stock split for which the value of your share decreases. So does that change your monetary value on the shares? Anupam says no. Does everyone agree? Sunil says yes. Yes, correct. That is called as a direct impact. Okay. Now, for example, let's say that I decide to change the name of my company. Now, will it change the value of your shares in the market?
No.
Ma'am, I have a small doubt. So when you increase the number, So
Mhm.
when you increase the number of shares, the total amount that I've spent on the shares is going to be same, right? It's just that the number of shares are going to increase. Is that correct?
But the value of each share will change.
Yeah, yeah, that will decrease, but the total amount will be same, right?
That is there, yes. But the value of
Okay,
each share will decrease, right? So we'll address that
okay,
little later in class. So that is called as a direct impact if it changes the value of your shares in the market.
okay. I misheard the question. Sorry. Thank you.
Okay. Now back to the point where I said I have changed the name of my company. So now my outstanding shares that are there in the market, the name of those shares also will change. So does that change the value of the shares in the market?
No, no.
No, exactly. So that is referred to as indirect impact or indirect effect. Is that clear to everyone? So write this down. What is corporate actions? Let me know once you're done and we'll continue.
Ma'am, does QIP, Qualified Institutional Placement, also comes under corporate action?
Sorry, can you repeat that?
QIP, Qualified Institutional Placement.
As far as I know, no. Done, guys? It doesn't fall under corporate action because for to do a qualified institutional placement, they don't need to submit a legal paperwork to the securities regulator. Okay.
Hello.
Yes.
Okay.
Hi, ma'am. Good morning.
Good
Can you
morning.
please just brief me about the definition of corporate action, because I was like 2-3 minutes late.
Yes, Preeti, it's in the definition itself. I don't think it is rocket science, right? It's explained clearly, right?
Yeah.
Okay.
Okay.
You have any questions here? It's clearly
Okay.
defined what is the definition, what is an issuer, what is a position holder, what do you mean by direct impact and indirect impact, or direct effect or indirect effect.
Okay. So, in a nutshell, if I'll conclude, corporate action is something like the actions taken by the company which will affect the stakeholder, basically the shareholders and the bondholders.
Yes, in one word, you can put it as position holder instead of saying shareholder and bondholder.
Okay. Okay. Yeah. Thank you.
No problem. So we're going to move on to why would an issuer undertake a corporate action event? The first obvious reason is for distribution of income. So if you're a shareholder, it would be dividends. If you're a bondholder, it will be coupon payments. Okay, that's the first reason. The second reason is to raise further capital. Okay. So let's say a company already has been listed, but after a couple of years, they want to raise further capital. So they'll do something called as a FPO, which is a further public offer or follow-on public offer. And if they want to raise new capital through bonds, they would issue new bonds with new principal and new coupon percentage or interest.
Just one quick question. Sorry to intervene in between. This further public offer is offered in the primary or the secondary market?
That will be primary, no, because it's the issue of new shares.
No further public. Okay, fine.
It's the issue of new shares from a company that is already listed because they want to raise further capital. So if you want to buy FPO shares, you don't directly buy it from the secondary market. You have to first buy it in the primary market from the issuer. Then you can sell it in the secondary market. Is that clear, Saurabh?
Yes, ma'am.
FPO is done to raise more capital, right?
Yes, further capital. Usually it is done a couple of years after the company has already finished its IPO or done its IPO.
So it will also result in decreasing of per stock price.
No, we'll discuss that a little further, what happens.
Okay.
Okay. The third reason is redemption of debt, which is nothing but when the issuer has to repay back maturing bonds. Why is that?
The bonds they have issued in the market to the investors.
Loans they have issued in the market or loans they have taken from the
debt obligation.
Banks.
Sorry, one of you. People, why do issuers...
Basically, the debt obligation.
Continue, Piyush.
That is basically the debt obligation which company has to pay.
Yeah, because why? They have issued bonds. So when they issued bonds, they in fact become what? Debtors, right? And they take on creditors. And what happens once on maturity? They're supposed to return the principal back to the investors. Yes or no? I know it's been a month since I haven't spoken to you guys, but it looks like all of you have forgotten your basic stuff. Right. The next reason is restructuring of issued capital. So what is issued capital? What is issued capital, folks?
Ma'am, it is the total outstanding shares in the market
Yes, correct.
issued by the company.
Like shares and bonds that are already issued in the market. They are called as issued capital. Okay. Example will be a stock split, reverse stock split, which we'll discuss a little later. Okay. Restructuring of issued debt against issued capital, which is nothing but, in other words, your convertible bonds, which can be converted into ordinary shares. The next reason is mergers and acquisitions. So what's a merger?
Two companies are merged between.
Integration
each
of
other.
companies are
And the name is
Two
they have a
companies
different name.
combined some business.
Yeah, so two companies completely merge together to form a new company. That's a merger. So what's an acquisition?
When company acquires
Acquisition
another
is
company.
Acquisition is something when the one company is
acquires another-
completely acquiring another company, taking all the shares of the company.
taking the control of other
Yeah,
company.
finding
For
the
example, Tata
hostile-
Motors have acquired Jaguar. So yeah,
Okay, cool. Good, yes. Good
more
example.
than
Yes.
51% of the shares.
Yes. So a merger is when two companies mutually decide to merge and form a new company, whereas an acquisition is one company will entirely take over the other company, take over the control, the board of directors and everything. Okay. And the last reason as to why an issuer would undertake a corporate action event is dissemination of information, which is nothing but, in other words, giving out information to its position holders, like your AGM. What's an AGM?
Annual general body meeting.
Annual general meeting.
Correct. Okay, so these are the reasons why an issuer would undertake a corporate action event. All right, take down this reasons. Let me know when you're done, and we'll continue with types of corporate actions.
Okay, I have one question here. Can I ask?
Yes, obviously you can ask.
Okay, in acquisition, the company is taking 50% share of the company which it is acquiring, or complete 100%?
It depends. To have a majority ownership over the company, it has to acquire at least 51%.
Right.
Okay.
Okay, so if it is 51%, then also it will be categorized under acquisition.
Yes.
Okay, okay, thank you.
You're welcome.
Hello.
Yes.
Hello.
Yes.
So in the acquisition, the name is changed. Like there will be one name. In the merger, there can be two names, right?
No, in a merger it will be one name. In an
In the strategic alliance,
sorry. See, it again depends. When we get to the when we discuss merger, so what can happen is, if one of the companies, let's say, stronger presence in the market, they might use that company's name when they merge.
Okay.
Okay. In an acquisition, what can happen is the other company's name entirely gets knocked off because it gets absorbed completely by the acquiring company. Okay.
Ma'am, last point, dissemination of information. I couldn't understand.
It's nothing but giving information out to the shareholders.
So means
Okay,
the AGM
like an
meeting comes
AGM.
under corporate action.
Yes, an AGM is considered
AGM
as a
is
corporate action. If, let's say, the company is deciding to hire a new CEO, so
Okay,
they'll
okay.
give out information. So that's a corporate action.
Okay, so
Dissemination
general
of
meetings
information.
comes under corporate actions.
Yes, it's a type
Okay,
of
okay,
corporate.
okay, okay, okay.
Ma'am, recently Vodafone is being merged to Idea, so that can be a better example of a merger.
Yes, that's a good example of a merger. So you guys will have classwork at the end of, or homework at the end of this class.
Hello.
Yes, Nikhil.
Hello. Yeah, the example of acquisition can be Reliance acquired a Future Retail.
Yes, there are lots.
Okay.
Okay, so we'll continue to the next topic, which is going to be types of corporate actions. So the three main categories are mandatory, voluntary, and mandatory with choice. So what this means is, if any type of corporate action is classified under mandatory type, it means the position holder doesn't have any choice in the matter. He has to take part in the corporate action event. Okay. A simple example would be, again, let's say if the company changes its name, the position holder cannot go back to the issuer and say, no, don't change your name, I like the old name. Right? He has no choice. He has to take part in the corporate action event. Then you have something called as voluntary. Voluntary means the position holder now has a choice if he wants to take part in the corporate action event or not to take part. An example could be a buyback. So you've all heard of buybacks, right? What's a buyback?
The company buying their own shares from the market or certain rate.
Yeah. So
Yeah, when a company is like when they have given the shares, then they are taking back it from the investor, and it is on a specified date.
yeah, so if now as a position holder, you can decide whether you want to give the shares back or not, correct?
Yeah,
So
right.
that is called as a voluntary type of corporate action, meaning here the position holder has a choice if he wants to take part in the corporate action event or not. The third one is, or the third major type is mandatory with choice. Now what this means is, again, the position holder has to take part in the corporate action event, but he is given an option to choose in the entitlements. And the simple example for that is, if a company decides to give out its dividends, it might say, I'll give you a choice between cash or stock. As a position holder, you have to make a decision whether you want cash as dividend or whether you want stock as dividend. But you have to make a choice and take part in the corporate action event. If you don't make a choice, and further on in the class we'll discuss, default something will be assigned to you. Are we clear with what is mandatory, what is voluntary, and what is mandatory with choice? Yeah. So we'll continue with the first category, right? Is, or rather, if you want to write these three down, do you guys want to write this down? Yeah, so write it down. So here I'll put examples as well.
Third point, I could not understand. Choose the entitlement that they want. Meaning?
I just gave you an example, right? Let's say if I was a company and you hold shares of my company, I'm planning to give out dividends. So I announce dividends I can give in terms of cash or in terms of stock. So as a position holder or a shareholder, you will have to make a decision whether you want the dividend in cash or whether you want the dividend in stock. Okay? You have to choose. It's mandatory because even if you don't choose, I would give you, maybe let's say as default, I would give you cash dividend.
I mean, recently, as I'm the shareholder of HDFC Bank, so MD and CEO of HDFC Bank changed. So, in which of these three, under which of these three category will it come?
Sorry, your last bit cut off. What was it? What sort of corporate action did they announce? Dividend payment? Hello?
No, in corporate action, MD and CEO changed, no?
Indian CEO change, then it will be dissemination of information.
Okay.
And under this, it would be mandatory because even though if position holders vote, sometimes they may not take the vote into consideration.
Ma'am, can you tell me in the corporates like have a maximum area of serving? Like Dityapuri has served
Nikhil,
so
slow
far.
down. Slow down. Half of your words I cannot understand. Tell me
I
again
want to
what
ask,
exactly.
there's a minimum age the person can retain as MDC of the bank or a company. Any
It
maximum age?
depends from country to country.
Okay.
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 All right. Can I continue? Can I continue, guys? Are you done writing?
Yes, ma'am.
Okay. So before we continue, we need to understand the difference of what is face value and spot price of a share. Okay. Face value is what you get in case if you return the share to the issuer. So for example, when the shares are issued in the market, it might have a face value of $10, but when it's actually sold in the primary market, it can be sold for 20 or even above that. Yes or no? Yeah. But let's say at the time of returning the shares, let's say you paid $20 to buy the share in the primary market. But at the time of returning the share to the issuer, will they pay you $20?
What
They'll
will
pay.
be the spot price of that share at
Hang
on
on.
that day?
Let's say that the stock price is not that great. Okay, you want to return the share. Okay, will they pay you $20, the original amount that you paid, or will they pay you face value?
Ma'am, they will pay the face value as it is the benchmark price which company has set of its shares.
Okay, so they will pay you face value. That's correct. Okay. Now, also face value is required when the company declares dividends. So when they're paying dividends, if the current share price in the market is $30 and they're saying I'm paying 5% dividend, will they pay you 5% on $30 or 5% on the face value?
Always on face value.
It's on face value, correct, not on the current price in the market. Are we clear with this aspect of what is face value of the share and what is the spot price of the share? Okay, so we'll continue. So we're going to do mandatory corporate action, the main one. Under that, the first one we're going to talk about is bonus issue. Okay, Preeti, yes, spot price is the current price in the market. Okay, bonus issue. So let's say company A announces that they're going to do a bonus issue where they announce a ratio of 1:2. Now here's the thing you guys need to be careful about. When an issuer makes an announcement and they give a ratio of 1:2, you need to understand the issuer is from which country. Whether it's a US country or US company, or if he's based on a he's a European company. The reason is this ratio will be read differently based on which market the issuer is from. If the issuer is from the American market, then it will be read as, for every one share that you have right now, you will get 2 additional shares. Is this clear to everyone? Yeah. If the issuer is in the European market, it will be read as, for every 2 shares that you have, you will get 1 additional share. Is this clear? Is this clear to everyone? Yes or no, people?
Yes, ma'am, understood.
Yeah. Preeti, listen carefully. Let's say if it was Apple. Apple is the parent company, or the issuer is from which country?
Yes.
US, exactly. So if they make an announcement saying, I'm doing a 1:2 bonus issue, then what does that mean is, for every existing 1 share that you have, I will give you 2 additional shares. Understood? Okay. Now, let's say, give me an example of a European company that is listed. Anyone?
City General, BNP Paribas.
Okay, let's take BNP Paribas. Okay. So let's say BNP Paribas makes an announcement. I will do a bonus issue and I'm announcing a 1:2 ratio. What now it means is, because it's a European listed company, it says that for every 2 shares that you have, I'll give you 1 additional share. Is this clear, Preeti, now to you? Okay, so we'll continue. For the sake of today's class, what we'll do is we'll use the American style of this thing. Okay, so company A announces they're going to do a bonus issue of 1:2 ratio. Okay, who decides the ratio? The board of directors. Okay, so let's say before the event, you're holding 10 shares of company A. Okay. Saurabh, no, we're doing American style, meaning for every 1 share, you'll get 2 additional shares. Okay. So let's say before the event, you were holding 10 shares. Now, the market capital of these 10 shares is $100, which should mean that each share is worth $10. Do you agree? Yes?
Yes, ma'am.
After the event, you will hold 30. Why? You already have 10. For each share, you're getting 2 additional shares. So you get extra 20. Now you're holding a total of 30 shares. Does everyone agree with this? Yeah. However, the market capitalization will not change. This is a very important point, folks. Even after the event has taken place, the market capitalization will not change. But now what will happen is each share will be worth $3.33. Okay. So what would it entail is, in a bonus issue, the number of shares would increase. The spot price, meaning the current price of the shares in the market, will decrease, but the face value doesn't change and the market capitalization doesn't change. Is this clear? Yeah. Why would issuers do a bonus issue? If they have excessive cash in as treasury capital, they might decide to issue bonus issues to increase the goodwill of the position holders. Okay. For position holders, what they get is they get additional shares which they can then sell in the secondary market for capital appreciation. Is everyone clear with what's a bonus issue? Yeah. So write this down quickly before we move on to the next one.
Hello.
Yes.
I'm getting confused here. Is it a stock split? Another name for stock split?
No, a stock split is different, which we'll address, which is the next one we're going to do. This is a bonus issue.
Okay, it seems similar. Okay, then we can discuss the difference later on.
It is not similar at all, Preeti. It's in the word itself, it is different. What does a bonus mean? What does bonus mean?
Bonus is something additional given to the shareholder.
Correct. Extra, right? Bonus, in other words, means extra. What does the split mean?
Split means we are splitting the existing shares
Exactly.
into
So
number of shares.
yeah. So
Okay.
how will it be similar then?
Okay, in bonus, for one we are giving 2 extra, but in a split, that one is getting splitted into 2.
Exactly.
Okay, got that. Thank you.
And ma'am, the question is, so initially they bought it for $10 each share, but now because of that bonus shares is nothing but 3.33. So they're getting an additional share with a less price, right?
No. Hang on. They don't pay for this. they're just getting the share additionally. It is given to them as a goodwill from the company. Understand this. Before the event, you had 10 shares. The face value of each share was 10 in the market. Or to make it a little bit more understandable, let me put it this way. The face value of those 10 shares is $5. Okay, face value. But the market capitalization altogether was 100. So each was 10, meaning the market price of each share was $10. Face value still remains 5.
Okay.
Okay. Now, after the event, you got 30 shares because it was a 1:2 issue. You had 10 shares, you received additional 2 shares. So total of 30 shares you have now. But the market capitalization doesn't change, which was 100, but now it is 100 divided by 30. So each share price in the market becomes now 3.33. Your face value will still remain 5. Is that clear?
Yes. Yes.
How excess of treasury capital led companies to go for bond issue?
Sorry, Piyush, can you repeat that question?
Ma'am, how excess of treasury capital led companies to go for bond issue?
Because let's say if they have excessive treasury capital and they want to maybe borrow more from the market instead of borrowing loan from the company, they might use that to issue bonds. Okay?
Yeah, ma'am.
Hello.
Yes,
Hello.
Preeti.
Oh, okay. So the market is also divided into like epic and non-epic market. So is it same like European and American market?
Epic and non-epic. This is the first time I'm hearing. Hang on. Like EPIC?
No, APEC or APEX.
APAC. You mean APAC?
Right.
So the APAC means basically your countries such
Association
as
Supporting countries.
yeah, so it's like
Pacific means China.
Asians Pacific side, correct? You're all Australia, New Zealand, Singapore, that all. That it's just for time zone difference.
Okay.
Okay, so it's the products that are invested are almost the same: equities, bonds, your derivatives, and all of that. It's just it's in a different time zone.
Okay.
Okay, so you have APAC, you have US, you have UK, you have something called as EMEA, which is emerging markets.
Yeah, right.
This thing. Okay. Not EMEA, EMEA, EMEA.
EMEA.
Yes. Can I continue, guys?
And so in India, what happens? US one or European one? I guess US one.
You will get depending on which market you support, right? So if you're in, like, let's say you're in trade settlements and the market you're supporting is APAC market, then your shift would start like at 3 in the morning and end in the afternoon. If
I
you're
am
working,
asking bonus share issue. Suppose SDFC Bank goes for bonus issue, so it will happen in US style or European style?
it's usually US style.
US style, right?
Yeah. Okay, the way the ratio is read is usually US style in the Indian market. Can I continue?
Yes, ma'am. Yes.
Okay. So the next one is stock split. Again, we'll take the same example or the same ratio. Company makes an announcement, they're doing a 1:2 stock split. So before the event, you had 10 shares, market capitalization was 100, each share was worth 10. After the event, now you hold 20. Market capitalization is still 100, but each share is worth 5. Now, what's the difference between a bonus and a stock split? We discussed a little earlier. In a bonus, what happens for every share that you had, you got an additional share. Okay. But in a stock split, every share that you held was broken into 2 shares. Is that clear to everyone? Yeah. Also, guys, this 1:2 ratio is dependent on the board of directors. It doesn't always have to be 1:2. Okay, it can be 1:3, 1:4, 1:2, depending again on the board of directors. Is that clear? Okay. So, an issuer does a stock split because the spot price of the share might be too high in the market. That would mean that they may not have many position holders. So it might not be that liquid in the market. So in order to make it more liquid, they do a stock split, which means they can get more position holders. Okay, for position holders, he will get extra shares again that he can sell in the secondary market. Also, the outstanding number of shares increases, the spot price decreases, and now the face value does change, but the market capitalization still doesn't change. So if we take again example, let's say these 10 shares has a face value of, let's say, $10 each. Now after the split, the value of each market price is 5. Now the face value also gets split. So the face value will become 5 now. Is that clear to everyone? That's another difference between a bonus and a stock split. In a bonus issue, the face value doesn't change. But in a stock split, the face value changes. Okay, quickly write this down before we get into something called as reverse stock split.
Hello.
Yes.
So, ma'am, the share the stock split you're saying, like the share value is so hello.
Yes, I can hear you, Mikir.
The companies who have a high stock price, they only choose the stock splits, or any company can choose. Like the company share is around 10,000, so not easily available to every investor.
It's again depending on the board of directors, Nikhil. No one is holding a gun to the head of the issuer and saying you have to do a stock split because your share price is high, right?
Mainly done in these cases. That's all.
What I'm trying to get at is it's again the decision of the board of directors. If they think that their stock is not that liquid because of the price being too high, they might decide to do a stock split. It's not necessary that they have to, right?
And if they issue the dividend, dividend will issue the half of the face value, right?
Yeah, what will be the current face value after the stock split?
Okay.
Recently, iShares, publicly listed company in NSE, went for a stock split of in ratio 1:10.
That means each share is split into 10.
Its spot price was around 21,000, so now it's around 2,100.
A little bit more affordable for people, right? Versus 21,000 per share.
Yes, ma'am. Yes, ma'am. But don't you think that bonus share issue is like hitting a gold mine? If the company is of good fundamentals like HDFC Bank or Apple, because if someone holds 100 shares and stock is in ratio 1:2 bonus share ratio, so one who has 100, he will get 300 shares instantly.
Yeah. So that is what investors would take into account when they're trying to invest also, the future of the company, how well it is doing. Maybe there's a possibility they might do a bonus issue.
Right.
Okay, can I continue? Yes or no? Not yet done. Preeti, you need to write faster. I don't get much time with you guys and I have to cover a lot. By the way, how come you guys didn't finish your level 2 yet? Because it's been almost a month since I took your last class, right?
Will asset management will also be covered in this class?
I doubt, Piyush, because corporate action itself is a big topic.
No, as it in the schedule, that's why I asked.
Yeah, I know it's in the schedule. What I'll do is if I can't cover it today, I will let Kiran know to schedule a separate class for asset management. See, technically, the classroom sessions itself is like 4-hour sessions, right? And asset management itself is a big topic. Corporate action is also a big topic. So I don't know what they were thinking when they clubbed both together and said cover it in 2 hours.
Ma'am,
How many more classes are left?
can you ask Kiran when he's sending the recordings, can he send in like video recording? Can he send like that? Because this audio recording is tough to understand. Like we need to see the video also, right?
So
last time we had that AML classes, okay? So he sent audio recording instead of sending a video recording.
So you reach out to him and tell him, no, because I don't know who took that session.
I mailed him, but he didn't reply anything on that.
Then send a follow-up email or give him a call. You have his number, right?
No, I don't have his number.
It should be in his signature. If it is not in his signature, ask him for his number.
Well, how many
And
more
also you
sessions?
can put
I can put what, Preeti?
How many more sessions are left for us?
So today I'm covering corporate action, asset management, stock borrow lending, regulatory risk and environment. I think that's four more classes. So previously it was a trade life cycle for both OTC and exchange covered.
Yes, ma'am.
Settlements, custodians.
Yes, ma'am.
Reference data management.
RDM, then your what do you say? AML KYC was done also, right? Okay, so that means these 4 classes are left for you guys for domain.
Okay, thank you, ma'am.
Right, can I continue? So the next is reverse stock split. Okay. So unlike your stock split, this is the reverse version of a stock split, meaning now the company wants to reduce the number of outstanding shares. So let's say company, sorry, company A makes an announcement that they're going to do a 2:1 reverse stock split. What it means that for every 2 shares you held, now it will become 1 share. Okay. So let's say again, hypothetically, before the event, you had 10 shares, market capitalization was 100, each share is worth 10. After the event, now your number of shares become 5. Market capitalization still remains the same, but the value of each share or the market price of each share in the market increases. Okay, and your face value will also change. So let's say if face value of each of them was 5, now the face value of each share will become 10. Is this clear? Is this clear, guys?
Yes, ma'am.
Okay.
So basically the value of the share increases, right? Reverse stock split. Initially it was
Yes.
reduced and here it's
Yeah.
increased. Okay.
Correct. So in a stock split, the value of the share decreases and the number of shares increases in the market. In a reverse, it is the opposite, vice versa. The value of the shares increases, but the number of shares decreases in the market. So in a reverse stock split, as mentioned here, the number of
Just a
outstanding
quick question:
shares.
why it is done, ma'am?
We'll get to that, no, Saurabh? Okay. So in a reverse stock split, the number of outstanding shares decreases, but the spot price or current price of the shares increases. The face value does change as well, but the market capitalization does not change. Okay. Reason as to why a issuer would do a reverse stock split. The primary reason is sometimes exchanges have a criteria that says that if your value of your share goes below a certain amount, they might delist you from the exchange. If you get delisted from the exchange, would it be a good thing for a company? Exactly. It won't be a good thing for the company. So in order to avoid delisting, the issuer might do a reverse stock split in order to increase the price in the market, but reduce the number of outstanding shares. Does that answer your question, Saurabh? Yeah. Other reason could be also, even if let's say the share price is still good, the issuer might think there are too many outstanding shares in the market. So for him, let's say if he wants to pay dividends out now, if there are too many position holders, it might be difficult for him to pay the dividends out to everyone. Right? Or in other words also, let's say it might be difficult for him to keep track of every position holder. Why is that? Why would it be difficult for an issuer to keep track of every position holder? Guys, did you understand my question?
Ma'am,
There are millions of position holders.
continuously changing their position by selling or buying the shares in the secondary market.
Exactly. So it might be difficult for an issuer to keep track of the position holder because his shares that he's already issued in primary market are now trading in the secondary market. So every day, maybe every second, the owner is changing on the shares, right? So it might be difficult for him to keep track of who's the current position holder. Is that clear? Okay. Is everyone clear with reverse stock split? Write this down quickly before we move on to the next. By the way, today the class will be till 1:30, okay? I'll give a break at around 12. Okay. So next mandatory type of corporate action we're going to discuss is something called as merger. Okay. So let's say company A, which is a listed company, and company B, which is also a listed company, they decide to merge completely, meaning they're going to merge their entire companies together entirely. All lines of businesses, everything will get merged into one new company, which will be formed, or a new company called as company C. So what would happen then is company A would tell their existing shareholders, for every A share that you hold, you would get maybe one C share or one new share of the new company, which is a 1:1 ratio if you have to look at it. Company B would then tell their shareholders, for every B share you hold, you will get 2 C shares, meaning a 1:2 ratio. Once the new shares are allocated to the existing A and B shareholders, now the old A and B shares that are listed would get delisted from the exchange, and the new company shares will get listed. Is everyone clear till here? Yeah. Why would companies merge? Again, to corner the market or to form a new line of business. One question might be why company A is doing 1:1 but company B is doing 1:2. The reason could be B's market capitalization might be larger than A's. Okay. Is this clear to everyone? What's a merger? This is a complete merger, by the way. Okay. Sometimes what could happen, instead of A saying, instead of giving a new name for the new company, if B is, let's say, like I said, the market capitalization is bigger for B, A might say for your existing A shareholders, you will get maybe one more share of B company. And then in that case, A shares would get delisted and B shares are still listed along with whoever from the A company who's got new B shares. Their shares will be listed. Okay? Not
Ma'am, could you
50-50.
repeat the last statement?
Sure. So
Hello.
let me say in this example, so let's say A and B decided to merge. Both are listed companies, but let's say B's market capitalization is bigger, right? And they don't want to go to the trouble of, like re-registering or rather registering a new company name, etc., etc., etc. So what they might decide is, instead of giving a new new company and a new share, A might say that I'll give you one share of the B company. So B shareholders and their B shares are already there. Okay, they might get additional shares from B because of the merger. But A company shareholders, they'll get now shares of B company. Okay, and then A shares will get delisted, but B shares will still be listed. Is that clear?
Okay, thank you.
Okay. So why would companies merge? To corner the market on a certain line of business or a product, or to form a new line of business. Okay, so write this down.
Hello.
Nikhil.
Hello. Yeah,
Yes.
sometimes I want to ask, like, sometimes the process of delisting fails also in the case of Vedanta. So
Slow down, Nikhil. So your rate of speech is too fast. Slow
sorry,
down.
now
Okay, can you repeat?
now I want to ask, like, sometimes the delisting of the company fails. So there are some criteria set by the SEBI. So you can't delist like that. We have to complete that criteria. Then we can delist our company. In
No,
the
no,
case of
no.
Vedanta, it happens.
See, delisting in normal circumstances, delisting would be if the company is going bankrupt or if it is, winding up.
Okay.
Right? This delisting is because of a merger,
Okay.
a complete merger. Okay.
Okay. Company delist for the two reasons only. They are winding up or they are bankrupt.
Yeah, in other circumstances, they would delist if they are winding up or they're going bankrupt.
No, this is not in the case of Vedanta. They have,
Sorry?
you have listened to Vedanta case, no?
No, I haven't, because I haven't been in touch in the market for quite some time. I have other things running in my
Actually,
head as of now.
Vedanta is about to delist. They have tried delisting so many times, but this time
Okay.
also they have failed to delist from the market because they have
Okay.
the bad debts also, loan also. They have to pay that also. So basically,
Okay.
they have not been delisted from the market. So that's why I want
Okay.
to ask, any procedure you can tell about the, like, SEBI guide give that you have to put that criteria on the point that you can delist.
Unfortunately, I don't know all the criterias of SEBI,
Okay.
but probably as of now, SEBI may not be allowing them to delist is because they want to first make sure that these guys can pay off, like do all their payments before they can delist.
Okay.
Okay.
So if they are listed, they are in the hands of SEBI. If they are not
If
listed,
the
they are not in the
company
hands of.
is listed, they have to follow the guidelines set by the securities regulator. Having
Yes.
said that, if it's a private company, they still
Yes.
have certain guidelines they have to follow by the securities regulator.
Okay.
Okay.
So the difference is mainly between the listing of the company and delisting company.
See, I wouldn't say listed, I would say listed company and private company. So if you say delisted company, that means a company that was listed once and now it is delisted. It's not on the exchange.
No, sorry, delisted, which is not listed. Sorry, not a delisted, which is not
If it is
listed.
not, if it's not listed yet, it's a private company, so they would have, like, they wouldn't maybe have to publish everything to the Securities Exchange Board in India. Okay.
Okay. Okay.
If it's a listed company, there would be certain separate guidelines and criteria that have to be followed.
Okay.
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 So the next type of mandatory corporate action we have is cash dividend. This is pretty simple. Nothing but company says, I'm giving dividends, I'm giving cash dividends. You have to take cash. You cannot come back to me and say, no, I don't want cash. I want stock, or give me extra shares or something like that. Okay. Is this simple enough? And always the dividend would be, or the cash dividend would be, a percentage of the face value of the share you're holding. Is this clear, guys? Yeah. So quickly write this down. We'll move on to the next main heading, which is your voluntary type of corporate action. Done?
These corporate actions like bonus issue and delisting and rights issue QIP, in this also investment bank help and they charge fees, or it is done by a company by itself?
Investment banks would help. Now, if it's an FPO, obviously investment bank will help. Distribution of income, investment bank doesn't need to help, because that's the company's this thing of distributing the income to the shareholders. A merger, definitely, a merger or an acquisition, definitely an investment bank will help. Because let's say if you are a company and you're into, let's say, producing coffee beans, right? Your area of expertise is coffee beans. Do you know anything about mergers? What criteria you need to follow? What is rules or guidelines set by the regulator? Do you have any idea of those?
Oh, not
Yes
at
or
all.
no? Yeah, exactly. So who was the best person to do it for you? Exactly. For which, please be aware, he's going to charge you a lot. He doesn't do it for free. Okay.
Okay.
So let's get on to voluntary corporate action. And after we finish voluntary corporate action, we'll take a short break and we'll come back and continue. Is that okay?
Yes, ma'am.
Okay. So write the heading down as voluntary corporate action. And under that, the first one we're going to discuss is rights issue. So rights issue is basically, let's say company A wants to raise further capital, which is an FPO. What it means is they've already done an IPO Now, after a couple of years, they want to raise further capital through shares again. Maybe they don't want to issue bonds. So they do something called as an FPO. So what does a right issue mean is, if let's say you all were company A shareholders, company A makes an issue, I'm doing an announcement, I'm going to do an FPO. What they're obligated to do is they have to reach out to their existing shareholders and offer the FPO shares at a discount before they can sell it in the primary market. Okay. Now, you as the existing shareholder, you can say, yes, I will buy the FPO shares, or say, no, I don't want to buy the FPO shares. If you say, yes, I want to buy the FPO shares, congrats, you'll get it at a discounted price. If you say, no, I don't want to buy the FPO shares, then the issuer would just go sell it in the primary market. Is that clear? But here, what it means is, you as a shareholder, you have the right to choose if you want to take part in the corporate action event or if you don't want to take part in the corporate action event. Is that clear? Okay, so write this down quickly before we move on to the next one.